Good morning, everybody. Uh, and everybody is a pretty small bunch this morning. There's so far only a dozen of you out there. Thanks for being there. I hope you had a great weekend. And I did, I think. Thinking back, it must have been good. I know I spent some time down at Smith Mountain Lake. So that was good. That was fun. Not my place. I can't afford a place down there, but I do have some friends. And it's good to have friends. All right, let's get right to it. Even though there's so few of you out there, so I don't know who's listening. I know you guys are listening. I don't know whether folks will see this before noon or not, but remember, you have homework due today at noon, and those of you here, I'm sure, are probably have it done. So, as they say, I may be preaching to the choir. However, just a couple of comments about the homework, and that is, I know I've had a couple of requests, and Mitch has had a couple of requests to extend the homework because the reason, and maybe some of you, I can't see everybody on the list right here. Pardon me, have requested such or would like such. Well, it's not happening. The requests so far have been well, because we haven't covered everything that's in the homework. Two things about that. That's right. As a matter of fact, we haven't in class covered everything that's in the homework, all the ratios and such. That's intentional. I'm not going to cover anything else regarding that homework set. We're moving on. Chapters 2, 3, 4, 5 is our next stop. So that's right. And sometimes you get questions that you have to figure out yourself. And life's kind of like that. So there will be homework questions. I guess I haven't done that so far. Maybe I've handled you all with a little too much. Anyway, never mind. Anyway, there will be homework questions on occasion that we haven't covered in class, but they're in the textbook, and they're right along with what we're doing in class. And you may just have to learn a little bit extra on your own. That's kind of what we're probably supposed to do, a lot more of that than we do. I think I do. I need to do a lot more of that than I do, although you don't like it. And I can understand that. But you'll learn so much more if you learn it on your own than listening to me blather on about it. So anyway, no extensions on the homework. It'll be due at noon. Thank you for understanding. You don't have to agree, but as long as you understand, we're in good shape. Time out a second. All right. Let's see. I don't see anybody in the queue. So anyway, we've got that midterm progress. We're almost there. I think that the grades scores for the midterm might be posted as early as tomorrow. And that may not be early to you, but I think, considering the number of students and the way that we're grading it, we're going through each student, and Mitch is doing the bulk of the tough work, and I want to publicly thank Mitch for his diligence. But combining the online part and what you did there, and then looking at your individual work and trying to, as best we can, as best you provided to us, reasons to give you perhaps more credit if you didn't, if you missed the question and you got 0 credit, giving you as much credit as we can on the midterm. For some of you, that's going to make a big difference in your score because you made little mistakes here and little mistakes there that uh, caused you to get 0 points on the online part. But you demonstrated that you have a better working knowledge than a 0, and so you'll get more credit. And hopefully, if the good Lord willing and the creek don't rise, we'll get those scores up there tomorrow or maybe Thursday. Count on Thursday because it seems like every time I say something will happen, it's always just a little bit later than that. Now, there is something I can promise you today. I can promise it to you this morning, actually, right after class, because I almost got it completed before class and I just ran out of time. I didn't actually run out of time. There was time, but I spent that time earlier sleeping and didn't get up in time to get it done. And that is your company analysis homework, and that will be posted. I have to finish wording the assignment properly, and once I get that wording completed, I will then publish the assignment. I'm that close. It's maybe 10 minutes, 5 or 10 minutes, 15 minutes away from being posted. And I want to show you what that's going to be. I've given you glimpses of it before, but I want to show you what that assignment looks like that's coming. Spoiler alert, I guess that's what one would call it. And there it is. And what's going to happen is you will select a company, and this will be a company that's publicly held. That is that there are stockholders, and there can be few or there can be many. This company would need to provide the reason we want publicly traded companies is so that we can get all the financial data that we need to form some of these ratios that we're working on for the homework, and will be on the final certainly at some level. So you will need to select a company yourself. It could be any one of a number of companies. It's possible that you personally know of a company that might be your favorite. Maybe it's a company you've worked for or with in the past. It could be that you need to go out to Google and do a search. And trust me, in preparation for this, I went out there to Google to see if I could find companies that I was not aware of, and I can find them. It may take a little bit of effort, but you can pull that off. So you find a company, and then it's going to be in a sector, different sort of industry sector. And if you have a question about that, usually if you look at an annual report from that company, and once you find that company, you'll be able to get their annual reports. Just like those ones I showed you in class last time, actually. Granite, for example, you go out there, I was showing you their annual report. You can get those, find those out there in the public sphere. And they'll be good at identifying their major. They may cross sectors. There's often these companies cross sector lines. They're a little bit blurred. So So they can tell you in their annual reports. And then you get to form ratios for these. So here's find the quick ratio for the company, calculate it, and based on their industry sector, you can see what the ranges are typically for those companies. And then, so we're going to do some ratios, and you can compare it to the industry sector that they're in. And then a bunch of these, not an overwhelming number. And then at the very end, you get to provide your opinion about this company. Now, this isn't gee, I think they're pretty good. And yeah, I'd invest in them. That's not what I'm looking for. I'm looking for something a little more gravitas. So here, it is a brief summary of your findings, but that may be a page, right? And you want to discuss the financial health of the company based on the ratios that you've calculated. This may end up being for some of you a 2-page summary. It's I don't need a 2-page summary. Let me say that as there's a debate about who said this, so I won't. I'll say Mark Twain, but Mark Twain wasn't the originator of this, I don't believe. Wrote a letter to a friend and said, I'm sorry that this letter is so long. I didn't have time to write a shorter one. And that means, of course, that the better writing is the crisper, shorter, edited version, and not the rambling, repetitive writing that you might see. So I'm looking for crisp and brief, but complete and accurate based on your data, and then based on your analysis of those data compared to the typical for the industry sector. And then, would you loan them money? Would you buy their bonds? Would you invest in their stock? So that's what I'm shooting for. Now, the good news is I will post this up today, and it won't be due until 3 weeks. It's 3 weeks down the road that is the due date. It'll be before Thanksgiving, just a little bit before Thanksgiving that it's due. So so that's this assignment. I'm going to post it as a Word document instead of a PDF. And so you can actually type on this if you want. You could just download it and put your data directly in here and then type up your response. Make sure you save it. Of course, you could always re-download the original, but save it with a file name that has your last name in there, and that's how you should submit it, is with your last name in the file name and the assignment, of course. I'll give it a homework number. I think this is 5. This will be like double points, homework double points, and so that should be helpful, I think, to many of you. Get some double points and some ways to crank up some extra credit that might offset some other lesser credit, I hope. So that's coming. Like I said, I'm going to post that incredibly close to right after class. And then you'll have 3 weeks to conduct it. And that'll also give you time. Don't let any grass grow under your feet here on this. 3 weeks sounds like a long time. It is a long time, but you need to find the company. That's going to take you a little bit. You need to find the data for the company. That's going to take you a little bit. If you could get that done very, very quickly, and then you can take your time going through it, and forming the financial ratios, uh, that'll be good. So that's your extended homework assignment. There'll be other homework assignments in the interim. So this won't be the only homework assignment going on, which is another reason not to let any grass grow under your feet, because there'll be other stuff happening as well. Thank you for your patience. Okay, let's talk about what we're talking about today, which is we're moving now from chapter 6, which was all about, we're still doing financial ratio. This still is construction economy. So we're still doing financial ratio stuff, but not ratios, financial stuff. But now we're moving a little further down the road and a little deeper into construction accounting. Of course, now some of that was covered in chapter 6. We looked at the balance sheet. If that's not accounting, I don't know what is. So, but now we're moving a little deeper and a little more detailed into an accounting. Today we're gonna dispense with chapter 2. I think we're gonna be started, get through it, and move past it. Chapter 2 today, because a lot of chapter 2 we've really already done, as you'll see. I'm going to be following, I have followed the text pretty closely. I'm going to be following it even more closely because of the nature of the material here. Some of you have had some accounting, some of you have not. This is kind of, this can be incredibly confusing stuff. When we start talking about debits and credits, those of you who've had accounting know that it's a hump you have to get over, and that sometimes the slope on that hump. You've been through speed bumps in parking lots. Some of them you can just kind of breeze right over smooth, and yeah, they're speed bumps, but they're not much. And other ones, if you hit them at a speed, they can jar you. And the slope on those things are very steep and rough. Well, I think in my experience and in me personally, debits and credits are a steep speed bump. So we're the good news is I'm not going to expect you all to be accountants or to handle deep accounting processes. You do need to understand some of it, and we're going to skim the surface, and I hope that we skim it at the right level. If we don't, it's my fault. The text is really good about trying to keep it at the right level, in my opinion. So that's why I'm sticking extra close to the text here. Accounting is not my field. I'm yeah, I know what's going on, but because I'm not as intimately familiar with this as I am with some of the other economic concepts, that's another reason I'm sticking very close to the text. I don't want to go off on a tangent that's either a favorite of mine or a head off in a direction I don't really understand. So I'm comfortable with the book. Chapter 2, we've talked about a lot of it. I'll talk about that here in a minute. Then we're going to go up through 3, 4, and 5 in the days ahead, and we're going to move reasonably smartly through those other chapters because of the level at which we're doing it. There's accounting practices. Let me look at something real quick if I can. and that is I just want to look at where I've posted the slides that I'm going to cover today. I don't even have a file for slides for today because I already posted it. I thought I posted it. Pro forma accounting systems was last time, and in-class financial analysis was the time before. Well, my goodness, embarrassment time. Let me look and see if I've got, here's construction accounting PowerPoint. I'm sorry, this, okay. Oh, there it is. Oh, hang on just a second. I am there. Okay, I found it. I'll tell you what, instead of me, no, that's not right. I just ask for your patience, and I will give you my apologies. I'm going to very quickly see what is today, the 20th. Today really is the 20th. Okay. So I'm almost there. I'm gonna upload. There we go. So I've created a folder in the files section, and I have just now uploaded the file that's got the slides for today. So that's up there. Again, that's just it's very poor form for me. That's not what I wanted to do. Very poor form, my apologies. But now it's up there, so I can get to these slides that I want to talk about today. And as always, I just don't like doing slides, but you're getting a heavy dose of them, and I'm doing them. So apparently I don't hate them, or I wouldn't be doing them at all. So let me share my screen here, and this is construction finance, construction accounting topic. Okay, so we're now moving a little bit further into accounting. Today we're going to talk about accounting systems briefly, the four basic types of accounting systems that you might run into, and the strengths and weaknesses of each, and the ones that would typically be used. The IRS does require certain types of reporting accounting for certain companies, and so you have to follow those rules. But it's also important that you know that again, this two sets of books things, and I believe if I look back, and I'm looking at my our textbook here, there's something in here that says, well, anyway, the first page, there's a one of the first headings is cost reporting versus cost control. And when you're accounting, you are reporting. I mean, that's the there's kind of there are multiple purpose for accounting, and two of the major purpose for accounting are number one, reporting, so that you're accurately reporting the finances of the operations of the firm, and you're so that not only you but your the stockholders, the general public, legal authorities, all can know the activities, the financial activities. They can know that you're being financially responsible and that you're accurately reporting data that result in you paying taxes, result in you paying perhaps dividends to your shareholders, responsibility to your lenders. So all of those individuals who have loaned money to whom you owe money know that you're properly managing the finances so that they will be repaid. It affects your credit rating. So if your reporting indicates that you're on a slippery slope, lenders will be less eager to lend to you, and when they do, they will charge you a higher interest rates to protect to because the lender's level of risk is increased, and so they need to put that risk into that interest rate that they'll charge you. All sorts of reasons. So there's the reporting side. There's also the managing side. So you need to make decisions day to day in terms of corporate decision making, how to invest your money, what to purchase, what not to purchase, what uh, what activities to subcontract, what activities to keep in house, um, how to pay your bills, how to submit those payments, who to hire, when to hire, how many to hire. All those decisions are decisions that are driven by your financial situation. And so we've got cost reporting and we've got cost control, and that's the management side of the ledger. It almost literally the ledger. We'll talk about the ledger here in just a little bit. So okay, so that's why we do accounting. And it's why you might have two sets of books, essentially. You you need to report things one way to the government. The government may require that you manage your finances and perform your accounting in a certain way. We'll talk more about that today and a little bit later. Um, but you may need to report things to yourself in a little different way because you need that information to manage processes within the organization. So sometimes these two sets of books, and there's some place in chapter 2, as I've read, I just can't find it really briefly, but talks about two sets of books and how that is maybe important. So cost reporting and cost control. Now, how do you build these? How do you build these systems? Well, you start with one of the very basic elements of your system is the general ledger. And there is a figure in your book, and I'm going to turn over there to it because I don't have detail in the PowerPoint, but I want to make sure that I talk briefly about detail that's in your textbook. And even if you have an older edition of the textbook, you're going to have this figure in the general ledger. In this edition of the textbook, chapter 2 is construction accounting systems. And I'm sure that whatever edition of the text you have, there's a chapter that's called construction accounting systems. And I'm sure they have the chart of accounts, the general ledger. Now, this is where I have to be honest with you. The people who I know in construction, and I don't know, well, I guess I have in the past, they're acquaintances, they're not friends, acquaintances in very big construction concerns. And so they don't worry about this necessarily level of detail that's presented here in the chart of accounts in the general ledger. But those people who are friends, who are more mom and popish, if you will, that run their own firm, the fellow who built my house in Blacksburg, for example, I got to know him quite well in building the house and then beyond. I've said this before, but a lot of people, in the construction world, the reason they're there, and I hope the reason that you're studying construction is because you love construction. You love making things. You love seeing things created before your eyes, right? And being a participant and feeling the participation in that process of creating. And that's a wonderful feeling. I'm not very good at it personally. So, but I know what it's like to see that creating. And I know the people who I know who do that, there's a lot of fulfillment there. However, when you are at the level of having, a small firm that's yours, you love that creating. What you don't want to do is then at all day, you may have been out in the field, you may have been hammering, I guess you don't hammer nails anymore, but essentially hammering nails and sawing wood maybe, and putting stuff up and building a truss and all the things that get done. You don't want to go home then at night and say, okay, dive into my charts of account, because by golly, that's important for me to do. And I love working with my chart of accounts. I don't know of anybody who has ever told me that. They go home and it's a pain in the neck. And the level of detail that you need can be a pain in the neck. And so I'm not saying, some of you may love this stuff, and more power to you. And I think that's wonderful because it will make that part of your life much more pleasant and maybe even fun. For the rest of us, we tolerate this stuff and then we hire a good accountant. But you do need to have that working knowledge, that fundamental understanding of what's going on. And over time, part of this is an overtime activity, and that is it'll slowly get into your system, and pretty soon you'll be able to manage it, and you'll be able to tolerate it. Sadly, for most folks, by the time you get to that level, you can then afford to really have somebody pay attention, and you don't have to pay attention to it as much. But that's another story, and everybody's story is different. But if you look on figure 2.1 in our textbook, whatever textbook you have that has the chart of accounts, you'll see that there is and this is, this is not the chart of accounts for everybody. It's an example of chart of accounts for a construction company, and you will see, the different numbers there. The 100 numbers should look kind of familiar to you, and notice that those are all, if you think of the balance sheet, right? We've got assets and liabilities. We've got current assets. And if you look at those 100 accounts, those look a lot like current assets, right? Matter of fact, 199 is other current assets. So that chart of accounts, everything that happens, every financial transaction that occurs gets is assigned to an account. Any money spent or received has to come from or go into an account. And sometimes you think of an account like your checking account, and your checking account, you do a lot of stuff with it, and you buy food, and you buy gasoline for your car, and you buy gifts for people, but it all comes out of that one account. Well, that's not the way it works in business. If it's food, it's out of one account, and if it's gifts, it's another account, and if it's fuel for your car, that's yet another account. So you have to kind of switch your thinking a little bit from having one account to having, you've got one massive, if you will, super mega account, but you have accounts for everything, every particular type of thing. You have accounts, and then you can see that you're longer to your fixed assets. You've got your current assets, you've got your fixed assets. Those are the 200 accounts. Starts with the building and land, and then et cetera, et cetera. There's what's called a contra account, a less accumulated depreciation. So 250, account 250 is your depreciation account. That's chapter 5. We're going to get there in detail, but remember that will accumulate assets that depreciate over time, that you use up, essentially your equipment, your pickup truck, if you're running your own shop, whatever that might be, would be your depreciable assets that then show up in that account. So then you can look at, continue to look down there, and you've got your 300 accounts are your liabilities. And that's, you've got current and long-term liabilities thrown in there together. And then the 400 accounts are the, owner's equity, retained earnings, things like that. It follows the balance sheet, if you will. And then starting the 500 account, that's your revenue, and those follow the income statement. So all of these other accounts, the 500 through the 950 down there, income tax, are all the things that are going to occur over time. Now, there's going to be some interaction, of course, between, and we'll talk a little bit about that, between the balance sheet and your income statement, back and forth. But hopefully that you get the structure of this chart of accounts of the general ledger. And the general ledger then interacts with, feeds, if you will, the balance sheet and the income statement. And you can see on this slide, we've got, okay, so you do your estimates and your bids, and based on those you build budgets. And remember, we can build a budget. You should have a budget for every project. You could have your own mini balance sheet and income statement for individual projects. We'll talk that's going to be included in the job cost ledgers and the equipment ledgers that we'll discuss here a little bit. From the budget, you have the actual performance on these projects, and those then turn into historical records. This is, you can think about, your balance sheet snapshot at a point in time is a historical record, right? But you can even drill further back now when we see these charts of accounts. You can drill further back to dive into these historical records reflected in the balance sheet or the income statement and find out how those happened. Where did those come from? How did those numbers get to be what they are? Okay, so we are next going to talk about the methods of accounting. And these methods are, we're going to talk about 4 different methods. And boy, I don't know about you, but this has been a extra boring. Yes, hey, you can say it in front of me. This stuff, and I make my own contribution to that boredom, by the way. I readily admit. But it's 8:40. We're halfway through, so let's take a break at this point before we get through these methods of accounting. I'm hoping that this, for those of you who haven't had accounting, that this will shed light on some of the things we saw on the balance sheet. So I'm going to spend some time on that. I don't want to interrupt it. Let's take hey, this is a gift from me to you here. Let's take actually a 6-minute break instead of 5. So I'm going to come back at 8:48 a.m. and we'll be back at work then. Okay. I like that with the internet that we all have kind of the same clock time here. We're back. So we and during the break, I was able to make a little bit more progress on getting that larger homework project assignment made up. So it was productive time away. Thanks for giving me the extra minute. Let's get back to where we were and talk about these different types of accounting. I can't see myself. Interesting. Well, you don't need to see me anyway, probably. Uh, but maybe you can see me and I can't see myself. I don't know. Anyway, methods of accounting. 4 basic methods of accounting: cash accrual, and sometimes you hear people say accrued. You've accrued an expense, or you've accrued something, and you may think that they're misspeaking, but they're not. They're just using an accounting term. That term is used in a lot of different ways, unrelated to accounting. But accrual is another type of accounting. Makes me think of Cruella de Vil, if you saw the 101 Dalmatians movie. The third is percentage of completion, and the last is completed contract. I'd like to, well, I'll do these in order since I have them in order in the slides here. So cost versus accrual, or cash versus accrual. So when you get the cash the cash basis for accounting is pretty simple. Um, when cash changes hands, you count it, right? You account for income when the cash shows up. You account for expenses when you pay the cash for them. So that's cash accounting, and it's easy. It's not. It's more difficult in a sense to account when you've got things that, for example, if you owe something, you don't even recognize that you owe it until you pay it. So there are some. It's simple. It doesn't require a lot of thought. It doesn't require a lot of planning. Well, maybe it requires a whole lot more planning to do it right, but it's natural. When you have cash, you've got it. When you don't, you don't. And let's be done with that. It makes things a little bit difficult, if you have a credit card, right? So now you do cash accounting, probably personally, because while you're using your card, it's not costing, you figure it's not really costing you anything until that credit card bill comes due at the end, and you account for those expenses when you pay them, not when you have incurred those costs by running your credit card. Well, in a business, we need some tighter controls, and that results in this accounting method called accrual accounting. And you can see in the picture on this slide, the revenue is recognized when earned and realizable, and the expenses likewise. When you incur the obligation to pay, like when you use the card, you already count that as an expense, and you can see that they're a little bit different animal. I'm going to go to the next slide that gets into some more detail on accrual. With accrual accounting, the revenue is recognized when you have a right to get it. So you have completed a task, and this is this task completion means that you should get paid. Well, you may not get paid immediately, but you have accounts receivable, right? If you think about accounts receivable on the balance sheet, well, that is on the revenue side, right? And you recognize that when you have a right to have that money. Now, you may provide terms for for the customer to pay you those accounts receivable, but they're recognized, and then there's some accounting. You do some accounting magic, and we'll talk about that accounting magic. It's coming up, those details. Um, that may then, when you actually receive it, it will account for the fact that you have actually received that amount, that revenue. And then it mentions here retention, and I may be assuming too much that you all know what retention is, and you live retention perhaps, and retention isn't anything in my typical world. Retention doesn't exist, but it's owner it's funds retained by the owners until everything is done. So it's like, hey, I'm holding back a little bit on you here, and it may actually be your profit part. Maybe it's 10%, and the owner holds on to that. It's kind of insurance that everything's going to get done right, and then that's going to be released. So retention is not recognized. It's not a revenue, and counted as revenue until the completion of the project. And so um, that you'll notice accounts receivable, and then you've got accounts receivable retention. That is never uh, never typically not considered revenue until everything is done. And retention is not exclusively a construction world concept, but in in a service world, sometimes that's also used, but it's not generally used in other industries. Expenses, so you have accounts payable, right? They are recognized when you must pay the bill. It's not doesn't mean the bill's been paid. It's just that, hey, you need to pay this bill. And there are terms with the bill, so you may not have to pay it for 30 days or 60 days. There may be terms with, if you pay it in 30, it's this. If you pay it in 60, it's something a little different. Um, and so that's nothing we're going to worry about right now. But so you have expenses recognized in accounts payable, and that's the accrual element. That's accrual accounting. Then accounts for things that are gonna come up, are gonna happen. You've been obligated to do. And it is true that you may pay income taxes on imaginary, that may be too strong a word, imaginary profits. And that is, you haven't you may have, excuse me, I have to clear my throat. Your profits may be based on accounts receivable, and you may not have received that money yet. So you may not actually have earned that profit yet, and yet you're going to pay taxes on it because of the with cash accounting, you pay taxes. The transaction, when that happens. Uh, so you're paying taxes based on that. That's kind of clean, if you will. With accrual, you're paying taxes on things that may be forthcoming. And so, yes, you may pay taxes on imaginary profits uh, temporarily, but yet over time those balance out from one year to the next. You can play games at the end of the fiscal year, right? At the end of the tax year, let's say. So you may play games at the end of that and put off some income. So you may not bill a client, a customer, um, until after the new year, even though you have the work finished now. That billing may not occur because you don't want those receivables accounted as revenue to increase your taxes for this year. Well, it's going to increase your revenue for next year, and it's going to increase your taxes next year. So it's going to all come out in the wash, but there may be timing issues that would be important to you. And with accrual accounting, you can you can change things up a little bit and manage your tax burden perhaps a little better. Now you're not going to make big swings here, but a little better than cash accounting. Okay, percentage of completion is, kind of self-explanatory. What percent of the project is completed? You recognize that revenue at that. If your project cost is $1 million and you're 50% of the way through, that's $500,000. Reasonably straightforward. In this method, you do count retention as you go as revenue. So you don't wait until the project is completed to count that as revenue. You count that in proportion, of course, as the completion proceeds through to 100% completion of the project. In like manner, expenses are recognized throughout the project. And as a matter of fact, how the completion of the project, that is, how much of the project have you completed, is driven by the costs that have been incurred. So if you have projected, this is going to cost $1 million, and you have so far spent 300,000, then you're 30%. You're at the 30% completion point of the project. So that percentage is driven by costs, and of course, then the expenses are accounted for accordingly. And since your revenue is recognized as a percentage, and as a percentage increases, and your expenses are as well, your profits then are recognized accordingly, and you would be taxed accordingly at the end of the year based on that percent completion, the profits on that percent completion. So as it turns out, the IRS requires a percentage of completion accounting for reporting for taxes, for tax purposes, requires percentage of completion for companies. Now this number is a year or two old, and it's a moving target, and can always be a moving target, because this is the IRS we're talking about, and some rules can change, legislation can change over time. So this is not etched in stone, but currently, as of a year ago, I would argue, if a company has had $25 million in business over the last 3 years, kind of a rolling 3 years, if you've had 25 million in business, you're required to use percentage of completion accounting for tax purposes. Or if you have projects that require more than 2 years to complete. So we're talking about large commercial projects, large perhaps civil construction sorts of projects that may take more than 2 years to complete. Then the percentage of completion is required by method is required by the IRS. Uh, again, you have to keep your eyes on those things, and the accountants do. So, if you're running stuff yourself, if this is your own small, very small construction company, and maybe it's just you and you're subcontracting the work and you're running that show, you don't have to worry about that because your projects, well, generally, you don't have to worry about that because your projects are not large enough nor long lasting enough to fall into the government's umbrella requirement for using percentage of completion. You probably would best work on an standard accrual basis, maybe even cash, but we'll talk that can have its own problems. I would suggest personally, at least the accrual, and with percentage of completion, you have you use accrual methods of accounting. You still use accounts receivable and accounts payable, and you manage according to an accrual type process, but the percentage of completion is what you need for reporting for government purposes for the IRS. So that's percentage of completion. Now, completed project is where you don't account for anything until you're finished, right? Everything is done. So all the expenses and all the revenue are all accounted for kind of at one point in time, project completed. There are I knew somebody who had his own very small construction commercial or residential construction firm. Pardon me. And that's the way he did things. It's kind of dangerous. You get lumps in your income, very lumpy, very hard to manage. You get all of a sudden you just get some influx of a whole lot of money, and you're out a bunch of money in the interim. So completed project is simple, very easy, and yet can be very challenging unless you have a cash hoard somewhere. If you're a very small outfit and you have a cash hoard that can take care of all of your maybe hundreds of thousands of dollars worth of expenses until you get paid at the end, it's real challenging to use completed project. And you might, well, that's what it is. It's not used a lot. You can read, I think it gets a paragraph maybe in your textbook. We won't be talking about completed project beyond this, and we really won't be talking much about cash beyond this. We're going to talk more about those other two that are really healthfully accounting related and record keeping related accrual and percentage of completion models. Those are the two that are 95% of the companies will be using those anyway. Okay, now we talked about the general ledger. Now let's just we're going to speak very briefly about the job cost ledger, and then we're finished with chapter 2. Notice that chapter 2 talks a whole lot about the stuff we've already done. That is, it gets into detail about things that we talked about. I debated, gee, should we talk about chapter 2 before we talk about the balance sheet income statement? But the details of the balance sheet and the details of the income statement are all in chapter 2. You can read the headings and you can read details about what each one of those might be. So if you were confused or you have other questions, there's a big chunk of chapter 2 that talks specifically about the details, the headings and the contents of the balance sheet and the income statement. Um, Now we've got that general ledger we talked about on all those accounts. Um, Now let's talk in a little more detail about the job cost ledger. There's a ledger then that gets you down to the cost incurred for the jobs, and you can see how the coding works here. And this is one of those details that can get really uh, uh, difficult. But this is you can break all of your costs. So within that general ledger, the 100s and the 200s, and then down in the income statement, you've got all the costs that you can incur. Well, you've got, and again, you might have it that there are different code structures. This is a general, very, very often used type of code structure. You could build your own. I would suggest, picking up one like this one and using this and not reinventing the wheel. The accountants have been at this a long time and they know what might be beneficial. But you've got job. So this is what particular job are you charging this to? Everything needs to be charged to a job. You're buying roofing materials, charged to a job. HVAC, charged to a job. Lumber, charged to a job. So we've got what job it is. Then maybe not, but maybe you have a phase code. So for what phase we're in that particular job. Then you have the cost code, which is that particular cost for whatever that may be. Lumber, roofing, HVAC, and each one of those may be, very particular. So maybe your cost code is not only roofing, that not just a general roofing, but the type of roofing that it is. So you might have a, asphalt, typical shingle might be one. You might have, what do they call it, architectural shingles. That may be another cost code. Cedar, another one. Tile, another one. Metal, maybe different kinds of metal roofing, different cost codes there. And then the cost type. So, and you can see how this breaks down. You've got the job number, so you'll have these for each individual jobs, and you could have, it could be that the rest of this might look identical, but the job code is different, so you know that it was a different job. And you can see how that breaks down. Phase, cost code, and then materials, labor. So you've got materials would be different cost codes. Labor, you may have different kinds of labor charged to that, and you will, and those all have their cost codes as well. And then finally, you've got the same thing for equipment, and you've got an equipment ledger, and you've got equipment number. So this is, this is a particular vehicle, for example, a particular pickup, a particular scoop, a particular track hoe, dozer, whatever you have. And then you've got, the payments and what depreciation is charged and repairs and maintenance. We have codes for those, right? So we'll have codes. And then under repairs and maintenance, of course, we've got further codes. So just like on the previous slide, just like we have this code structure, I didn't put it in here, we would have a code structure for the equipment ledger, like the job cost ledger, like the general ledger. We would have broken down. So every expense that you incur, you can put a label on it that identifies that cost for a job or a piece of equipment or whatever it might be, or whatever labor it is, all those things. You know exactly where it went. You may know who it went to. You know why it was spent, and you have a tracking system. for that. So that's the equipment ledger, the job cost ledger, the general ledger, and this is also included in these slides. This is not something for today. Also included in these slides, debits and credits. And that is where we go next. That's chapter 3, I believe, and that's where we go next time. So what do I expect you to know out of all of this? Well, you have your book, so you can look through chapter 2, and I absolutely encourage you to do that. I want you to have a general understanding of, okay, we have these accounting systems. We know we're going to get into detail with these codes, right? We're going to get into detail on what gets spent, where it is spent, how much is spent, those sorts of details in our accounting system. I want you to understand, the fundamental differences between cash accrual, percentage of completion, and completed types of accounting systems, and understand the ledger business at least to a certain level. And we'll get into more of that in a little bit. But then we're going to be moving into accounting and moving and debits and credits and where they go and why they show up this way. And we're not going to spend a ton of time on that, but you'll need to be familiar with that. And that comes up in chapter 3. And that's where we're headed on Thursday, is chapter 3. So we're finished with chapter 2. The homework assignment that'll be coming up this week will be a combination of chapters 2 and 3, so you can keep your eyes open for that. I will post that long-term, that 3-week homework assignment. That'll be posted up here very, very, very quickly after class is finished. Thanks for your patience again today as I was stumbling around earlier, especially. I hope you have a wonderful week this week, and I will see you Thursday morning. Take care of yourself and stay healthy.